Bitcoin has been on a wild ride lately. After climbing to record highs earlier this year, the world's largest cryptocurrency has now slipped into what many are calling a bear phase, falling more than 20% from its peak. Prices recently dropped below the $100,000 mark, which had been seen as a strong support level, and that's made investors nervous. Trading volumes have surged as people rushed to exit positions, and the overall mood in the market feels cautious and uncertain. A big part of this downturn has to do with the global picture. Investors everywhere have been pulling back from riskier assets because of broader economic worries. There's a lot of tension around interest rate policy, inflation, and slowing global growth, and that's spilling over into crypto. When markets get shaky, Bitcoin, despite being viewed by some as digital gold, still tends to move with the risk-on assets, so it's been caught in the same wave of selling. Inside the crypto world, leverage has played a major role in amplifying these swings. Many traders were heavily leveraged, and when the price started to dip, forced liquidations kicked in, pushing it down even further. Outflows from spot Bitcoin ETFs have added to the pressure, and some mining operations have been squeezed by higher costs and shrinking margins. All of that together creates an environment where prices can move sharply in either direction in a short amount of time. Technically speaking, Bitcoin has broken below a few key levels that traders watch closely. That's led to more automated selling and even weaker sentiment. On-chain data shows that some long-term holders are continuing to accumulate, which is encouraging. But there's also been an increase in coins moving onto exchanges, which can signal that some investors are preparing to sell if the slide continues. Now, even with all the turbulence, the bigger picture for Bitcoin isn't all negative. Institutional interest remains strong, and many big players still view it as an asset with serious long-term potential. Some major banks have gone on record saying that after this period of deleveraging, Bitcoin could look more attractive compared to traditional hedges like gold. The overall market infrastructure has matured too. There are more regulated products, more transparency, and more professional investors involved than ever before. For anyone thinking about investing, this is where a balanced approach makes sense. If you already believe in Bitcoin's long-term story and can handle its volatility, this kind of pullback could be a reasonable opportunity to start building a position slowly rather than diving in all at once. A dollar-cost averaging approach, where you invest small amounts over time, can help smooth out the wild swings. It's also smart to set clear risk limits and never put in more than you can afford to lose. In the short term, Bitcoin could stay volatile. If markets stabilize and institutional inflows return, we could see a recovery toward the $150,000 range over the next year. But if sentiment worsens and macro conditions tighten further, another drop toward $80,000 or $90,000 isn't off the table. That's why patience and risk management are key. Overall, Bitcoin is still the dominant force in crypto, and the long-term case for digital assets hasn't disappeared. But right now, the market is going through a reset, shaking out the excess leverage and testing who's truly in it for the long haul. For long-term investors, this may be a time to cautiously accumulate. For short-term traders, it's probably best to stay nimble and disciplined. And as always, remember, investing in crypto comes with significant risk. Prices can move fast, and past performance is never a guarantee of what comes next. Stay informed, stay disciplined, and invest only what you're prepared to lose.